this two-part video. And in this case, we're going to take a look specifically at overhead variances. In the first part, we looked at the flexible budget variances for direct materials and direct labor. And now we're going to look at the overhead variances. If you did not see the first part, you should see that before seeing this part. For any assignments or exam problems, we will be told how many actual units were sold. And we're going to use that to determine the standard cost for direct materials, direct labor, and variable overhead. These things are variable costs. They vary with how many units are sold. So we have to know how many units are sold before we can figure out what is the standard cost for that type of thing. With fixed overhead, however, a budgeted amount is put on the budget that's an estimated amount, and it doesn't depend on how many units are sold. So if we know we're going to need insurance on the factory building, we estimate that next year it's going to cost us X number of dollars, then that isn't going to change if we use 52,000 units that we sold or 50,000 units that we sold. The insurance is still going to be the same. So that fixed overhead we won't have to worry about how many units were sold. Now let's remember some things about overhead that we studied before. Remember that we accumulate the actual cost for overhead, and then we apply or allocate those costs to the jobs based on a rate. And the rate that we apply is a formula, and the main one that we learned about is the predetermined overhead rate. And we can also you might see this called the standard overhead allocation rate. Means the same thing. So we calculated a rate and then we multiplied it by however many of that cost driver that each job had, so that we could apply the overhead. The actual overhead costs for purposes of variance analysis are divided into variable overhead costs and fixed overhead costs. The variable ones, of course, meaning they vary with the number of units produced. So if we're making dog houses and nails are an indirect material, then remember that nails then are an actual overhead cost. Direct materials like the shingles and the lumber, that's going to go straight from materials into work in process. But the indirect materials go down into overhead. So if, however, I make more dog houses, I'm going to need more nails. So the indirect materials is going to vary depending on how many units I make and sell. However, fixed overhead, like insurance on the building, is going to stay the same. So here's a picture of the T accounts of what we did in the past. We had all our actual costs, including our indirect materials, our indirect labors, any repairs on the factory building or equipment, insurance on the factory building or equipment, property taxes on the factory building or equipment, and depreciation on the factory building or equipment. All went into overhead as a debit, because those are the actual costs. As the year went on, we applied the cost based on our predetermined overhead rate. Now, we make that rate usually ahead of time. So in the summer or the fall, we're going to estimate all the costs for next year for overhead, and we're going to estimate the cost driver for next year, We'll take the total estimated cost for next year, divided by the total estimated driver for next year, and we get that predetermined overhead rate. So if the overhead rate was $2 for every direct labor hour, then I would see on job number 123, if it had 10 direct labor hours, I would multiply 10 times 2, and that would be $20 that would be applied in overhead, meaning I would credit overhead and debit work in process. I would also apply that $20 onto job 123 job cost sheet. So our predetermined overhead rate, that $2 in my example, is also called the standard overhead allocation rate. We're allocating or applying that estimated amount. So the actual costs are on our debit side. The estimated amount is on the credit side. Then at the end of the year, we look and see, how close were we with our predetermined overhead rate. Did we estimate really well? Then our credit side and our debit side should come pretty close. And we'll just, whatever excess there is, if we either overapplied or underapplied, would just go straight to cost of goods sold. Now here we have also showing in here that we are dividing out for purposes of variance analysis. I'm not just concerned about the total actual cost. I want to divide those into variable and fixed. So I have here, in this particular case, I have 3 variable overhead costs, which is indirect materials, indirect labors, and repairs. So the more items I make, the more I'll be using the machines, and therefore probably the more repairs I'll have. And the more indirect materials and indirect labor I will also probably have if I'm making more things. So these are variable costs. Fixed costs in this case show insurance, property taxes, depreciation. These are all, I'm going to estimate these out for next year, and then as I actually spend, then what I actually spent goes in the debit side of overhead for those things. But they don't change just because my number of units that I sell goes up or down. Of course, we also looked in the past in Chapter 4. We also looked at mixed costs, which may include items of variable and fixed, and we would have to calculate out, we'd have to divide those mixed costs into their variable and fixed components. Then what we're going to do is we're going to calculate a separate predetermined rate for variable overhead and a separate one for fixed overhead. Again, we normally don't do this maybe for the putting on the job cost sheets, but definitely for variance analysis, we need to have this because we need to investigate the variances, and so we need to divide them out into variable and fixed. So for the variable, we're going to take the total estimated variable overhead costs, once we determine which ones those are, and divide them by the total estimated cost driver. And remember that a cost driver could be direct labor hours, machine hours, numbers of products. It could be a variety of things. The fixed overhead rate will be the total estimated fixed overhead costs, like insurance, and divide that by the total estimated cost driver for the year. So for Cheerful Colors, which is the company that we used for our example back in part 1 of the video, let's say that their total overhead, they estimated it to be last year $62,500, and they broke that down into a variable of 37,500 and fixed of 25,000. Together those equal the 62,500. And the cost driver for Cheerful Colors is direct labor hours, and they estimated that this year they would have 12,500 direct labor hours. So the total predetermined overhead rate that they use for applying overhead to the various jobs, the total rate is the 62,500 total overhead estimated cost divided by the 12,500 direct labor hours. And that gives us $5 per direct labor hour. So each job, they would take how many direct labor hours that month for that job, multiply it by the $5, and they would credit overhead, debit work in process, and put that amount also on the job cost sheet, just like we did in Chapter 4. Now, however, for variance analysis, we need to break that $5 down to the variable and fixed components. So the variable overhead rate is the 37,500 estimated variable overhead cost divided by the estimated cost driver, 12,500 direct labor hours. And we get $3 per direct labor hour. The fixed overhead rate is the $25,000 that we estimated for fixed overhead divided by the 12,500 direct labor hours, and that gives us $2 per direct labor hour. Note that the $3 variable rate and the $2 fixed rate should together equal the $5 total rate. So now we're going to take a look at variable overhead. So if our standard cost is $3 per direct labor hour that we just calculated on the previous slide, and our standard usage is 13,000 hours for the 52,000 boxes. Recall from part 1, we were told that the standard of direct labor hours is a quarter of an hour for every box of crayons. So the 52,000 box of crayons that we sold times a quarter of an hour for each one is the 13,000 hours that we expect to use of direct labor hours. Now, if I want a total cost that's on the budget, on the flexible budget, we would have 13,000 hours that we expect to use times $3 per direct labor hour for variable overhead, and that equals 39,000 total would be on the budget for variable overhead. If, for example, our actual cost for variable overhead is 30,160, and we actually used 10,400 hours, the total flexible budget variance that we need to further analyze is the total that we budgeted, this total standard, which is 39,000, minus the total actual, which was 30,160, and so that difference is 8,840. Since the actual is less than the standard, that is a favorable total variance. Now we need to take that 8840 favorable total variance and break it down into two parts, just like we did with direct materials and direct labor. We have a cost variance and an efficiency variance, and it's the same formulas. The cost variance is the AC, actual cost, minus the standard cost, and that difference times the actual quantity. And the efficiency variance is the actual quantity minus the standard quantity, that difference times the standard cost per unit. So let's take a look at cheerful costs, cheerful colors. The standard overhead rate we said was $3 per direct labor hour for variable overhead. And the actual amount of direct labor hours that we used was 10,400. And the actual cost that we actually spent for variable overhead is $30,160. So what would be our actual variable overhead rate? Well, that would be the $30,160 that we actually spent divided by the 10,400 actual direct labor hours. And we get $2.90 per direct labor hour. That's how much we actually spent per hour. Our formula for cost variance is the actual cost per unit minus the standard cost per unit, and that difference multiplied by the actual quantity. We now have everything we need to plug these numbers in. The variable overhead cost variance is oftentimes called the variable overhead spending variance. Remember that that's just another one of the same words for cost variance. Price variance, rate variance, spending variance, all is the same as cost variance. Okay, so I take my actual cost per unit, so it's $2.90 per direct labor hour is what I actually spent, minus my standard cost per unit, which is $3 per direct labor hour. So that 10-cent difference times 10,400 actual quantity of direct labor hours that we used. And that equals 1,040 variance, cost variance. Okay, is it favorable or unfavorable? I go back to the beginning of my formula. 290 actual is less than the standard that we thought we would use, and so this will increase operating income, and it is favorable. Now we take a look at the efficiency variance. Okay, the efficiency variance is based on how many hours did we use versus how many hours did we think we would use. Now we thought we would use 13,000 hours for 52,000 boxes of crayons. And our actual direct labor hours was 10,400. Okay, our standard overhead rate cost is $3 per direct labor hour, and our formula for efficiency variance is the actual quantity minus the standard quantity, and that difference times the standard cost per unit. So now we have everything we need to plug it in. We have our actual quantity, 10,400, minus our standard quantity of 13,000 hours. That difference times $3 per direct labor hour is $7,800. Is it favorable or unfavorable? We go back to the beginning. 10,400 is less than the 13,000, so it is favorable. Now we can make sure that our two parts equal the total variance. Our total variable overhead variance was 8840 favorable. That was from a few slides ago. Okay, now we've broken it down into two parts. The 1,040 favorable cost variance and the 7,800 favorable efficiency variance. Since we have favorable and favorable, we're going to add them. So we add the 1040 favorable plus the 7,800 favorable, and that does equal the 8840 favorable total variance. If it didn't, then we did something wrong on one of those two variances or both, and we need to go back and fix it. Okay, so we have explained the total variance by showing that we have more operating income because we used less labor than we thought we would, and we paid less for variable overhead costs than we originally thought we would. Fixed overhead variance, since the fixed amount doesn't vary and go up and down with how many units we sold, it's just an actual, this is how much we think we're going to spend next year for insurance, and now next year comes, and how much did we actually spend for insurance, and we compare those things. Okay, so our fixed overhead variance is not two parts. It's just one part, the actual fixed overhead minus the budgeted fixed overhead, and that's our difference. So our budgeted fixed overhead that was on our flexible budget, and we had a few slides ago, was $25,000. If the actual fixed overhead turns out to be $23,920, then we use our formula of actual minus the standard. So the $23,920 actual minus the $25,000 we set up in the budget is $1,080 difference. Our actual is less than the standard, so that is a favorable fixed overhead variance. At this point, we have done all of the variances, and we can take a look and make sure that they all coincide and match the grand total variance of the operating income between the operating income of the flexible budget and the operating income of the actual. Here is a chart similar to what's in your book, only your book shows what's on the right-hand side as being on the top and going down, as opposed to I have the stuff on the right and it moves to the left. So on the right-hand side, we had the direct materials cost variance of $97.50 favorable, the direct materials efficiency variance of $22,750 unfavorable. We did that in the previous slideshow. Together, those explained a $13,000 unfavorable total direct materials variance. Going down on the right-hand side, our direct labor cost variance of $20,800 unfavorable, our direct labor efficiency variance of $31,200 favorable. Together, those equal a total direct labor variance of $10,400 favorable. Going back to the right, we had a variable overhead cost variance, which we did in this slideshow, of $1,040 favorable. We had a variable overhead efficiency variance of $7,800 favorable. And we had a fixed overhead variance of $1,080 favorable. Those three are all favorable. We add them all together and we get $99.20 favorable total overhead variance that includes variable and fixed. Now, if I take a look in the middle column, we had $13,000 unfavorable of direct material variance, $10,400 favorable of direct labor variance, and $99.20 favorable of overhead variance. We would add the two favorables, subtract the unfavorable, and we get a grand total of $7,320 favorable flexible budget variance. This is a variance that would be between the operating income of the flexible budget and the operating income of the actual. So our actual grand total operating income was $7,320 more than we thought it would be. Then we broke that down into direct materials, direct labor, and overhead. And then we further broke that down to analyze exactly what is making up all these variances. Why do we do that? Why do we need to worry about breaking it all down? Well, oftentimes we use in real life a process called management by exception. And this is where we're calculating these variances. That's only the beginning. Now we need to investigate those variances. Why did they happen? Who is responsible? And so oftentimes a company will set an amount, like a threshold amount, and they'll investigate all the variance above that amount. And they question those variances that are outside those accepted parameters. Variances are investigated regardless of whether they are favorable or unfavorable. Just like we talked about in the previous video, we had a favorable direct materials cost variance because we paid less for paraffin than what we thought we would have to. But we ended up using a lot more paraffin than we thought we would. So did the quality of the paraffin cause us a problem? So just because something is favorable doesn't necessarily mean that it's a good thing. You always have to keep that in mind. If and only if the investigation leads to the knowledge that future costs are different from what was set in the standards and are expected to remain so, do we then change the standard? We never change the standard simply because the actual costs are different. So Cheerful Colors, using management by exception, they set $5,000 as their parameter. And then they will investigate any variance that is more than $5,000. So here are listed all the ones that were more than $5,000, which is most of them, okay? And they will, even the favorable ones, they're going to investigate those. Now, what kinds of questions are they going to ask? So the purchasing manager is in charge of direct materials cost variance. And remember, that was a 97.50 favorable. So what kind of questions are we going to ask that purchasing manager? Things like, how were you able to purchase paraffin at such a reduced cost? Did you compromise on quality? Will you be able to continue this same pricing? Maybe he didn't compromise on quality. Maybe there was some problem out in the factory that caused us to use more paraffin that wasn't related to the quality of the paraffin. And he just got this great reduced cost for the paraffin. We need to know, can he keep this up? Is this like a new vendor that he found had the paraffin at a cheaper price and it's still the same quality and we're going to continue to use this new vendor? And so in that case, if this is now a permanent change, we might consider changing the standard, okay? If this was a one-time thing, maybe he switched to a new vendor and they gave him a one-time, reduced cost on the paraffin. But starting next month, the paraffin maybe will still be a little bit cheaper than what we paid it with the old vendor, but, might still be close anyways. Now, the production manager might also be called the foreman. This is the person that's in charge of the workers out on the factory floor. And they're responsible for the efficiency variances. How much paraffin did we use? How many direct labor hours did the workers do? Which affects also the variable overhead cost variance, or efficiency variance. So the production manager is who we're going to go to for direct materials efficiency variance, direct labor efficiency variance, and the variable overhead efficiency variance if direct labor hours in particular is used. Okay? So the production manager questions that we have: why did the production workers use more paraffin? Did something happen? Did we have a big spill or a machine got it too hot and ruined it? Or, what happened? Was this a one-time thing, or was it because the paraffin quality was low and we kept having to fuss with it to get it to work and ended up using more because of that. So we need to find that out. Was there excessive waste or a large spillage? As far as workers are concerned, how were the workers able to produce batches faster? Remember, we thought we would use 13,000 direct labor hours, and we only used 10,400 direct labor hours. How were we able to do that? Okay, was it the fact that we had more experienced workers than normal? Okay, did we have some kind of incentive for the workers to work faster? Of course, that could also have caused excessive waste and spillage of the paraffin if the workers are trying to go too fast, because they're going to get an extra bonus if they work faster or something like that. So how is it that they were working faster? Which variable costs were less than expected? So that we might need to take a look at the accounting department for some of that. So the indirect materials and the indirect labor, the production manager is usually in repairs, things like that. The production manager is usually going to be able to give us an answer, but there may be some of those variable costs that we might have to look at the accounting department and see if they can let us know. Okay, the questions to ask human resources. Why were workers paid more per hour? Okay, the human resources department is the one who's in charge of hiring the workers. Oftentimes at these factories, they don't hire a permanent employee. They hire workers from an agency, a staffing agency. And so these are getting per hour based on the staffing agency says, well, you can have this worker for this week for this amount, and you can have that worker for that amount. Okay, and so if we call up to if human resources calls up to the agency and gets workers that were paid more per hour, why is that? Did the cost per hour just go up because the staffing agency is now paying them a higher rate, and so now they're charging us more to use those workers? Or did we get workers that had more skills or more experience? Okay, did we pay more of some kind of benefit or incentive or bonus? What made the rate per hour go up? And will this continue? Should we change the standard if the staffing agency permanently changed it from $12 to $14 an hour for the average price that we got to pay, then that's going to continue the rest of the year. We probably need to go back and change the standard. Okay, this